So welcome everybody, and as I say, we'll talk for about sort of 20, 25 minutes. So I'll pass over to Andrew in a second, and then we'll answer all of your questions. So Andrew, just want to give us a brief overview of the markets and where we stand right now.
Yeah, that's the idea. We've still got a few people coming in, so we'll we'll just keep chatting away for a second. But the idea of this is very much that we provide you an overview, I suppose, of where things have got to, and maybe a little bit of a chat about what's going on at the moment. But what is most valuable from our point of view out of this session is if people ask questions. So we'd encourage you to ask questions any way you can. Generally, the chat seems to be the best way to do it. So if you're happy with that, please do so. I'm going to share the screen and hopefully get this right, so that you can see the presentation that we're working our way through. Bear with me one moment.
We can see a screen with a whole lot of presentations there. Is that one right there?
Yep, that's one.
All right. Go far away.
So I hope everybody can see that one okay. What I did last time, and I just feel is useful for a bit of context, is just to look at, and we'd like to look at the long term. I mean, we encourage our investors to take a very long-term view of the market, and what financial markets are doing. So this chart shows the performance of the three main income assets, so the less risky assets that we invest in over the course of the last 10 years. And what it's done, it's just indexed back to 10 years ago, August 2014, when if you started off with a single dollar at that point, you'll see the three lines there. Bank bills is basically putting your money on term deposit effectively. And as you can see, that's gone up very steadily over the course of the last 10 years, very flat in that period when interest rates were extremely low from late 2019 basically through to later in 2021. But then you can also see the really dreadful performance by bonds, longer term interest investments, from basically just after COVID through until quite recently. So that if you had invested in a 90-day bank bill, basically money at the bank 10 years ago, you'd have almost exactly the same in the bank today as you would if you'd invested in what should return a lot more, global bonds or New Zealand bonds. And that's just a reflection of that real rise in interest rates that happened from roughly mid 2020 through till basically the beginning of this year. And things have stabilized now. In fact, long-term interest rates are falling as we speak. And we'll cover off that in a moment or two. In terms of shares, though, the picture is considerably different. Most of all, if you just look at the scale on the left-hand side there, you're talking about basically 150% higher over the course of the last 10 years from the beginning of August 2014. And it is unusual, particularly it feels like the last maybe 2 or 3 years, the market has just gone up very, very steadily. And it is disappointing to see the New Zealand share market having done extremely well for the first 8, 9 years, over the last 2 or 3 years hasn't done so well. And it's gone pretty much sideways now for a couple of years. It probably reflects largely the type of company that's on our stock exchange. We don't have a lot of big tech stocks, and that's what's driven the performance of those two, the global lines. And the fact that, as you'll see in a moment, the fact that the two lines have broadly gone parallel over the last, the global shares over the last couple of years, reflects the fact that the New Zealand dollar hasn't really changed a great deal over that period. So whether you were hedged or unhedged for the last couple of years, it hasn't made a great deal of difference. But over an extended period of time, the hedged performance has been a little bit better. And then just to come down to focus right down to just the last year, and again, just to put a little bit of context on things, Again, the New Zealand market actually has managed to, the New Zealand share market has managed to rally a little over the course of the last 12 months, but still not particularly spectacular. And in fact, you would have done just as well, if not better, in bonds than New Zealand shares. However, the global markets have done considerably better. And again, that's been largely driven by the tech sector. So as you can see, you've got a return of well over 20% from either the hedged or unhedged bonds for the last 12 months. So that was just to try and, as I say, provide a little bit of context. I don't have any more pretty pictures to show. What I'm hoping is to elicit a few questions, but what we could probably do is just talk a little bit about the things that are influencing the market at the moment. And the major focus is on central banks and pretty much how much they're going to cut official interest rates as opposed to whether they will or not. And the big meeting goes on. It goes on 2:00 in the afternoon in US time, so it'll be the morning for us on Thursday, when the Federal Reserve in the States are expected to cut rates by at least 0.25%. And at the moment, and the anticipated rate cut is more likely 0.5, so 50 basis points, which would be extremely unusual for the US Fed to move that much, but it is a reflection of concerns that the economy over there is slowing quite rapidly, and that the higher interest rates that they've had to control inflation are no longer required. And the reason it's become such a focus is exactly that, the worries about recession. The danger is if the Fed are seen to be behind the 8 ball, the market may get a bit concerned that 0.5% interest rate cut's not enough to get the economy going. So we're expecting potentially a little bit of volatility over the course of the next few days, depending on exactly what the Fed say. And locally, everybody is expecting the Reserve Bank here to continue cutting interest rates. At the moment, the market is anticipating again at least 0.25% cut at the next meeting at the beginning of October. It may even be 0.5%, which again, there is a danger that the market perceives that to be the Reserve Bank reacting too late, and that again could cause a little bit of volatility. And Sam, have you got anything you want to add?
Yeah, and so up until now, those falling interest rates have been very supportive of equity markets, particularly internationally. And of course, also in the United States, you've had the rise of what they call the Magnificent Seven, the 7 big tech stocks, which now represent a huge chunk of the market capitalization of the US market. Do you know what that would be in total, Andrew? Approximately the Magnificent Seven of the US stock market indices. It would be something in the region of 1/4 of it, would it?
Yeah, I mean, I was going to say that the top 4 are almost 20%.
Top 4 are 20%. So you have a massive concentration in the 7 biggest tech stocks, and that's a concentrated bet. That means that you really need a reasonable number of them to be doing reasonably well to support the market overall. Otherwise, it could tend to drift down. So I think the perceived risk in the equity markets now, particularly in the US equity market, has gone up because of the concentration around these big global tech stocks. Where they will go, we have no idea. We don't predict the direction of markets. What we make sure is that you are diversified in your investments. And so hopefully if any one of those companies fails, then obviously that won't have as big an impact on your investments or on the funds that invest. So there's been that. So there's been interest rates going down, supporting equity markets. There's been a concentration and really an obsession with tech. And we have it. And then, of course, you have the US election coming in there as well, which is a little bit of a wild card. It is difficult to know what the impact of this will be, because it's hard to know, A, what the election outcome will be, B, what the reaction of the politicians and the public, let alone what the financial markets will do, depending on who gets elected. And of course, remember also that there's a good deal of congressional and Senate seats that are up for grabs as well. So the power balance in the United States is highly uncertain at this stage. Now, the one thing we do know is that financial markets don't like uncertainty. And so while we don't predict it, the one thing that we know is that there is the possibility for a reasonable amount of unpredictability politically in the United States coming up. And of course, around the world, there may be that as well, even though, and so counterbalancing that is a relative degree of certainty that interest rates are trending down for a period of time, Andrew, would you would say? And that's globally around the world. And of course, because you're earning less money to stick it in the bank, you are more inclined to stick it into riskier assets like the share market. So, as always, as uncertain a world as it ever is out there, so the first rule is to diversify your investments and have them spread and try not to pick winners. Yeah.
Just response to a couple of questions that have come through already. Now, I'm hoping, Karen, that you could see some charts eventually and not just a blank screen. I'm sorry if that was the case. I'm hoping that my sharing worked. It seems to have done. William, oh, good, Karen, thank you. And William, I'm not sure why the chat's not working, but if you do have anything you want to ask, obviously put it through here. And then Tim, as Sam mentioned, yes, I completely agree. The US elections are likely to mean there is a decent amount of volatility coming through from changes that are, the atmosphere that's in the US. It's obviously been a pretty interesting to watch so far, let alone what we're going to experience in the next few months. But the strongest likelihood is, and I listened to a very interesting presentation from a big US think tank the other day, that the Republicans are likely to control Congress and the Senate just because of the makeup of the seats that are up for grabs this time. So it makes the winner of the presidential election extremely important, because if it's Harris, she's going to have problems getting legislation through, but she will obviously be able to block the Republicans putting through anything too extreme. However, if our friend Donald Trump were to win over there, it could easily put the Republicans in an extremely strong position. And on balance, markets are concerned about what's come through considerably over the last few months. They're very concerned about Trump's idea on tariffs and what that could do to global trade. So on balance, I think Trump winning with the Senate and Congress in support would be seen as not particularly positive for global markets, but time will tell.
That's a view we would share as well. As a general rule, trade tariffs have been bad for growth in any country that have brought them in. The last 100 years of prosperity in many ways is a testament to the economic activity you get when you actually remove impediments to trade, allowing countries to specialize in the things that they do best and them to sell to each other. So this is sort of, economics 101. But there is a school of thought now, and it's a protectionist school of thought, and this happens in history, where people think that they would be better off by closing their borders and bringing things in-house. I think our sort of reasonably strong view would be not even the United States, with an economy as big as it is able to provide all things to all people at a reasonable price. So what tariffs does is not only slow down trade, but it also actually increases inflation. Because remember, it puts an imported cost on anything that the Americans will be buying that comes in from overseas. So, and the markets will be spooked about that, and quite rightly so. It makes for a very good political headline, but it makes, in many cases, for a really horrible reality. So, I think that it's sort of interesting seeing that in the New Zealand context too, because right now we have an economy which really seems to be on its knees a little bit, right? There's a lot of layoffs, unemployment rising, disabilities going up. We've actually noticed in our own hardship inquiries in KiwiSaver that they've gone up to, they'd be pretty close to all-time highs now. So people are clearly feeling a lot of stress out there. And this is where the great interest rate debate comes in, because the Reserve Bank is, charged with getting inflation down and under control. And when that happens, you tend to get a period of prosperity. When people have stable inflation, companies invest and all that sort of thing. The problem is that right now it's almost darkest before dawn. That we've had a slowing down which comes from high interest rates and inflation. Interest rates are starting to come off now, but are they going to come off fast enough to actually get the economy going quickly enough? And this is where, Andrew, we use this phrase, right? Reserve banks do surgery, with an axe, right? It's a very blunt instrument, interest rates. It's incredibly important, and it has that effect over the long term. But in the short term, you can do things that can almost be unnoticeable. We've noticed this, right? Like people hardly notice the last rate cut, right? And so you have to have 2 or 3 or 4 in succession before you start to see changes in not only behavior, it's not even that. Before the changes in behavior comes a change in attitude. And the attitude is just suddenly people becoming more positive about the outlook. And we really haven't seen that across the board yet, right? People saying, changing, okay, interest rates are going to come down. I feel like I can invest. I want to buy that new car. I'm going to go out to restaurants and bars, all those sorts of things, in the anticipation that things will be better. We just haven't seen that yet. And it's pretty horrible out there.
Yeah, absolutely.
Yeah.
And that actually feeds very nicely into the next question on the list here, which is when is Simplicity going to lower our mortgage rate to match the banks 1 year? And I think this is exactly as Sam's intimating, is to me what's going to be very interesting over the course of the next 3 to 6 months is how quickly the banks now bring down their longer term fixed rates. Where ours is a floating rate, we'll be reviewing it again when the Reserve Bank meet at the beginning of October. I think it's October the 9th, might be the 6th, whichever. But we'll be reviewing again, and I would say the way things are going, if the Reserve Bank moves their rate again as we expect them to, then we'll be following along. And from our point of view, we will just continually follow what the official rates are doing. The banks have the advantage of, well, basically the systems that they have to allow them to set much lower long-term rates, knowing that in the end it'll work out well for them. Our preference is to maintain just a floating rate as low as we possibly can in the market, while still giving everybody a decent return on their money, and that allows our borrowers to repay quicker if they want to, and are able to. But yeah, that will be reviewed again at the next time the Reserve Bank meet in the first week or so of October.
And it's pretty unusual that our rate would be above the bank's 1 year rate, right? So usually it is obviously well below their floating rates and usually pretty consistently below their 1 and 2 year rates. So I think we're in a slightly abnormal set of circumstances right now. But as I say, we'll get and review that. The idea of our mortgage business is so that members can make a fair return on their money, which is less volatile than sticking it into sort of bank instruments or equivalent instruments. They can make more money than that in a less volatile way, but also that it's a really good deal for our first home borrowers as well. So the idea that you can make money and do good.
Right. So this is definitely one for you, Sam. In terms of our future product development, thank you very much again, Tim, for the question. What excites you the most?
Well, it's interesting. It's not so much a product, but it's an investment philosophy, which I think is kind of interesting. What we're spending a lot of time looking at the moment is infrastructure, stuff like electricity, water, all that, roads, all that stuff. Where New Zealand clearly has a very big deficit. That's not unusual in the Western world, but also that we have this huge pool of KiwiSaver money, which is now, yes, $110 billion and growing, and it's very long term and it's all of our money, and trying to sort of bridge that gap. How do we get this money invested in an asset class, which in theory, with infrastructure, should be really reliable in terms of returns? You're able to invest a lot of money and it really helps generate a lot of economic growth. And overseas, it wouldn't be unusual for pension funds to have between 5 and 15% of their assets in what you call unlisted infrastructure. Clearly we own shares in the power companies and Infratil and so on. So we're in that listed infrastructure space to a certain extent, but it's the unlisted infrastructure which we're having a look at. We spend a lot of time looking at these things. We sort of aim before we fire, and sometimes we choose not to fire. So that's looking pretty interesting there. The other areas that I guess, sort of starting to have a look at are, would we be expanding our private equity investments, which have been very successful so far? We're having a look at that and debating through that at the moment. And then every now and again, things pop up that we have a look at. Should we be involved in insurance? Should we be involved in the grocery or food sector? And if so, how? So, we're always very open-minded about these things. But I would say the one that we're spending the most time on right now is infrastructure. We just sort of around here to make money, do good, and also, to be honest with you, make life more affordable for ordinary New Zealanders. That's what we want to do as well. So, no promises on anything, but we're lifting up a lot of rocks and kissing a lot of frogs.
Sam is anyway. Craig, yes, the idea of mortgage rates is that they'll keep coming down with the OCR, and therefore, yes, if you're not borrowing with us because either you can't or you don't want to, then my advice at the moment would be, not that I'm allowed to give advice, of course, would be that you don't fix for too long. And I don't know, Sam, but we don't really have an update on offering home loans for non-first home buyers.
Yeah, no intention to do that at this stage because we just don't have enough money yet. When we've got $20 or $30 billion, we might look at doing that. But right now, what we're doing is offering it to first home buyers because they're the ones who probably most need the help. It was also, from a member's point of view, to the lowest risk lending as well. So you can justify a lower rate there. So I totally get that you need more affordable lending. Trust me, if we did have the money to offer refinancing, we just would. Probably as soon as we offered that, within a day, we'd have a huge demand and wouldn't have enough money to be able to lend out. So at the moment, no, but something we'd like to look at in the future if we get big enough. Yeah.
Now, as far as the Homes and Income Fund, oh no,
sorry. People read the question, or do you want?
I'm about to read it.
Okay.
Yeah. So as far as the return from the Homes and Income Fund, it has, as you say, been running along. Thanks, William. Has been running along very stably at sort of 5 or 6%. It's linked to a market, but at the moment, the reality is most of the fund is sitting in. It's not cash, but it's in very short-term investments that are very stable. And the reason for that is that the way the whole property development piece works is that Simplicity Living, who's the company all of our members own that's doing the developments, they just need their money on a fairly consistent basis, but only once a month and just in lumps that get spread across all of the different funds. So although the Home and Income Fund has got a reasonable allocation to that property fund, it's still in the early stages of being actually used by Simplicity Living. And we draw down more out of the Homes and Income Fund because it's got a greater allocation, but as I say, it's just taking a little bit of time for that to come through. And just on the second half of your question, which is how is the rate of return determined? Within the fund, it's, as I say, at the moment, it's investing in relatively short-term instruments that are running along at a reasonable yield, so in that 5 to 6% bracket. When the funds are deployed by Simplicity Living, it's worth understanding a little bit about how that return is generated. And it's a combination. Firstly, the company already owns $150 million worth of property, and so that will change. We have those valued regularly, and that affects the value of the company. And then any development that's ongoing, there's an internal accrual of 10% that goes into the return on those, because there is a risk to property development. There is also the use of money. We need to compensate our investors for the fact that money is being used for something. And so that is the other component of the return from Simplicity Living, which is the property fund. And so we expect it to be a steady type of investment. We're not expecting anything spectacular, but we believe it will provide that long-term investment.
It was designed to provide really, really stable returns all through the cycle. So remember, it has a bunch of cash it invests in. Then there's the first home mortgages that it invests in, and they're very stable performers. Then it has Simplicity Living, and how that makes money is it gets money from the rents, it gets money from the revaluation of the properties that it owns and rents, and then it gets money from the development. And as Andrew said, as we are building things, every dollar we put in of investors' money, we pay them a 10% return while we go through the development phase. And then once the property is finished developing, it gets revalued, and you get that revaluation upside or downside. It can go either way, so far upside, but and that's how you make your money. So, the Homes and Income Fund is designed to be reliably unspectacular in terms of volatility, and just a really stable place to have your money. Yeah. The question here: how does the tension in Europe and Russia affect our investments? Well, it's a very interesting question because
Yeah.
obviously it does, in the sense that it creates uncertainty, and markets hate uncertainty. But of course, with the uncertainty in that part of the world has been somewhat overwhelmed by the certainty of interest rates coming down at the moment, right? So in theory, the market should perhaps arguably be a little bit more nervous about what is going on than they are. But right now they've been very focused on US interest rates in particular, which tend to lead the rest of the world. So quite what happens there, we don't know, but I think it's a very fair question to ask.
Yeah.
Never forget that. I mean, war is sometimes good for business, but it can also be very bad for it as well. Yeah.
Yeah, and it's interesting in that context that there are, we don't invest in any of the stock markets that, if you like, are directly impacted by that in that part of the world. There are no developed markets, so it makes it quite an interesting one. From Joseph on the YouTube channel, what are the risks of moving from a passive low-cost offering to a more active investment portfolio management, including rental properties, etc.?
Yeah.
Can we continue with the low-cost model? Do you want to address?
Yeah, so we continue with the low-cost model. All of these things are within the low fees. We fund them internally, or in the case of Simplicity Living, we own the company, which pays the bills to develop these properties. So we certainly can keep it within a low-cost model. That is, that's synonymous with simplicity. And then in terms of the active versus passive, it's kind of interesting, eh? So some people would call, for example, our investment in Simplicity Living active because we're actively building properties. But of course, the intention there is for that to be a long-term, actually quite a passive source of income. We hold the properties, we rent them out, we receive the income. And so actually a lot of what we are doing, while the individual transactions might be called active, the long-term intention is that we have a very passive, diversified portfolio, which rewards our members for the risk that they initially took in those active investments. So it's active sort of becoming more passive over time. Bearing in mind, of course, that our so-called active strategies are actually about 6.5%, 7% of our money anyway. So well over 90% is in the traditional low-cost index passive. And there's no reason to suggest that that will change dramatically in the sort of near or medium-term future, because we will only invest in things like Simplicity Living, mortgages, or private equity, where we really feel that the nature of our members' money, long-term, sticky, around there for large ticket, invested by, a non-profit owned by a charity, we will only invest in those ways where we think that gives us and you a competitive advantage and therefore longer-term, better risk-adjusted returns. So this is all about making you more money by taking advantage of the nature of the investments that we have and the organisation that we are, and we'll only do it under those circumstances. And then hopefully we end up with very big, very diversified, portfolios there, and that, is part of an even bigger and more diversified group of investments that you have in the funds that you own.
Yeah. I mean, I would only add just a very small phrase in here that I think sets the scene for it, and that's buy and hold. So in all of our investments, we're not actively trading. We're not trying to beat the market as such. We're simply finding things which we believe are going to offer very long-term value. And even in our private equity fund, the idea is not that we're getting in and out of these things. We're trying to find companies that need a little bit of capital for the long term, and we're just along for the ride.
That's a great phrase, Andrew. Buy and hold. Maybe we should move you into marketing, mate. So another question here.
Yeah. The relationship. How is the relationship? Thanks again, Tim. How is the relationship between ourselves and DWS developed? They are a tremendous bunch of people to deal with. Extremely helpful, very responsive, and that's not to say Vanguard weren't, but of course we were just an investor in their funds, whereas for DWS they are our sub-manager. So the relationship is probably a lot closer than it was with the people at Vanguard, no matter how good that was at the time. I don't know if you want to sort of.
No, I think it's gone super well, eh? Yeah, just super well.
Great, yeah. And the funds, I guess the proof's in the pudding there too. The funds have been performing increasingly as we would expect, which is in line with their benchmarks. There were some big cash flow changes in the first month or two. For the equity funds, that was actually to their benefit. The bond fund got a few basis points less than they should have done, just through sheer volume. But over the last six to 9 months, the funds have been performing extremely well.
So thank you, Synonymous, who said love our high returns and so on. That's lovely. And from another one from actually Joseph, congratulations on reaching $7 billion. When is the next fee cut? And maybe at Vanguard levels. Great question. So as you may know, we've cut our fees 6 times in 7 years. I'm trying to remember it now, or 7 times in 6 years. Anyway, a lot. And it's fair to ask when will the next fee cut be, because we grow. So if you think about what we do with the fee revenue that we receive, it really achieves 4 things. So first of all is we have to run the business. The second thing is that we need to grow the business. We need to spend some money on getting growth because members benefit from growth. You know, the fee cuts are only possible by virtue of scale and size, right? So that's the second thing. We run the business, we grow the business. Then the other thing we do is we obviously give money to our foundation. We give 15% of our fees to the foundation, which are now running at well over $6,000 a day, and almost we're sort of honing in on $9 million of donations over 8 years there. So we'll keep on doing that because that's what we do. It's actually part of the competitive advantage too. Being a charity gives us access to a whole lot of stuff which benefits members. So we run the business, we grow the business, we give money to charity, and then we also have to have a rainy day fund, right? So we keep some money in reserve to make sure that no matter what happens in the markets, we can basically keep running the business. So that's pretty sensible, right? Rainy day fund. So we think then if all of those things are in place, then we give a fee cut, right? And as we have done. So we've been able to, and it's a balancing exercise, right? So at the moment, we did a pretty big fee cut at the end of last year. And what we're doing now is we're still running cash flow positive, which is great. We're putting a little bit more money into the rainy day fund as we get to be a bigger business. We obviously have to hire more people. We now have about 35 staff. And what we're going to do is now spend some more money on growing the business next year. So we'll be upping our marketing budget for the simple reason that will, we believe, allow us to grow faster. And if we grow faster, then we get the economies of scale to then give another fee cut. So I can't make any promise on fee cuts other than I say we have a pretty exceptional track record in doing that. And as a non-profit owned by a charity, that's obviously very close to our heart as being a very, very low fee provider, because we think that's the principal way that you can get, value, and why our funds will outperform. This combination of what we have is overwhelmingly passive index investment, but then a buy and hold strategy in areas where we have a competitive advantage in our own local New Zealand market. We'll win, and then as we grow, then we'll pass on those benefits. So that's a very long way of saying can't promise anything, but it remains as always front of mind. Yeah.
Totally.
Yeah.
So a very interesting question here from somebody who's anonymous, which is taking my phrase buy and hold. As they rightly say, at some point we need to sell as the investment is what we have to live on, live our futures on. How do we balance that? And I guess the simple answer to that is that if you needed your money tomorrow, 90% of the investments can be liquidated immediately. So that's somewhere up at well over $6 billion we could sell over the course of a few days if we absolutely needed to. But of course, we hopefully don't. But in the broader sense, the idea of that buy and hold is not that you can never get out of these things. It's simply that we're not looking to trade out of them in the short term. So if we were to buy into a private equity company that's on a growth strategy, it's paying dividends, we'll stay with them for as long as we can. But if one day we get to the point that there's more people leaving the funds than are joining, we will have to look at liquidating stuff. But that's really a long time in the future. At the moment, for example, KiwiSaver, it's just as Sam always calls it, a rising tide. It's just a small amount of money coming in every day, which means we've just got to keep investing, which is great. But we're a long way from being in the position that we would need to start looking at selling out of anything we invest in.
And if we had to, we can sell the homes that we own, we can sell the mortgages that we've lent to. These are all actually very sellable investments. It's just a matter of not whether we would think we get a good price for it, it's just how long it would take to do that. And we would have hope in the normal course of business, plenty of time. Can you elaborate on the newest investments in New Zealand startup companies? How do you assess the risk factors when choosing which ones to invest? Well, in startups, we actually don't sort of pretend that we have particular expertise there. We outsource that to Icehouse Ventures. And in the 3 funds we have invested in Icehouse Ventures, we have about 65 startup companies that we're invested in. So if you want to see what we're invested in, the best thing to do is to go to the Icehouse website. They'll tell you about it, but equally also we have those companies listed. Well, in fact, we have the funds that we're invested in, Icehouse, listed on our website as well. So we leave that to the experts. That's what they get on and do. The reason that we do it that way is they really get up for it. It would be very difficult for us managing $7 billion to be able to staff up a whole venture capital team to be able to make what would be very small investments in the context of our overall funds. Yeah, so we have a great relationship with Icehouse Ventures. They know what they're doing, and we'll carry on with that.
But then what we do have are a couple of people, one in particular, focused very much on those businesses I was talking about, who are already established. They're private equity, they're not tradable. They're private equity investments, and they're established companies that are already generating cash flow, and that may need a little bit of equity for some reason. And so that's the other strategy. So, but as Sam says, Icehouse Ventures do the startup or early stage stuff.
So I think that finishes our questions.
That's all the questions we have. If anybody has any, thank you. Somebody. How do you gauge how well your private equity holdings are performing when they are not traded or priced on a stock exchange? So the first answer is we've got a target return for our private equity investments, which is 3% over the market, as in 3% over the New Zealand stock market, which over the last 5 years, it's more than achieved. In the last 3 months, not so much, because the New Zealand market's suddenly done quite well. And as you say, private equity investments don't get valued as often. We still value them monthly, based on a model which takes account of any changes that there have been to either the economy or the industry of each of the investments. And so we can gauge reasonably how they're doing, but of course they're not traded, so there is no. And
that's an independent. That runs that valuation. So it's not just us. It's someone outside, external, independent valuation. And remember that they get audited every year as well for their value. So it's as robust a process as you can get, but completely acknowledge it's not traded on the stock market. So it is not revalued as often. Yeah.
Yeah, I mean, something which and a point I've made to a couple of people recently is it's all very well that they're not tradable and they're not valued regularly. But if you think about a company like Fisher & Paykel, the value of Fisher & Paykel actually doesn't change that often. It's just that the stock market price of it changes with almost supply and demand. So the actual underlying value of the company, it's not what's changing so regularly. It's the share price, which does not necessarily mean the same thing. And so with the private equity investments, provided you're taking account of, like I say, the economy and any changes in the industry that they're in, how they're actually doing relative to their own competitors, those sort of things, you can put a reasonable value on what that company is worth relative to where you bought it in the first place.
As one other question here, will there always be KiwiSaver funds that don't hold any active investments that we can choose if we just want index funds? Well, I guess the cash defensive fund is that. Is there any? I think pretty much every one of our funds will have some mix of those growth investments. None of them are huge. They were collectively overall there would be currently about 6.5%. But it depends on the fund you're in. You can have a look at that allocation. We don't separate off, let's call it the active or the buy and hold investments into separate portfolios from the index ones, because we firmly believe that you get better risk-adjusted returns by taking advantage of them in our local market. So the answer sort of is no. There are investment funds where you can do that. You can buy New Zealand share funds, New Zealand bonds, global stock market funds, global bond funds that don't have anything that we do here in New Zealand in there. But in terms of active investments, or the buy and hold investments as we would call them, but I don't think there is any one of our diversified funds that doesn't have something that we do in that area. And then from Joseph, any intention to invest in renewable energy to fix the market and also reap benefits from the huge climate change impact economy? In a funny way, Joseph, we already do, in the sense that we have pretty large holdings in the big gentailers, and a lot of those are, companies like Meridian have an awful lot of renewable energy. But I think what you're asking for is, would we look at more private market investments or infrastructure investments in that? Look, we're just starting to look at this. It is a possibility. It's sort of really too early to tell, but we're only going to be making those investments if they're overall a small part of the overall portfolios, and if we really have a competitive advantage where your money is getting better risk-adjusted returns than they would by investing in the gentailers that are listed on the stock exchange. Next question from Tim.
Yeah. I'll read it out. Thanks again, Tim. Following on from the buy and hold selling question, what about as individuals? At some point, most members will want to take money out of Simplicity funds rather than into Simplicity funds. Do we have any future annuity product offering?
No, we don't. We may consider that in the future. Nothing's off the table there. Annuities in New Zealand, it's a very long, complex answer, but basically the lack of a proper long-term, very liquid bond market makes pricing annuities very difficult. So that's why I think one reason why we don't have annuities. But equally also, some of the investments we're making are starting to have annuity-type characteristics. By that, I mean that they're designed to produce very long-term, stable returns. The mortgages would be one example of that. Simplicity Living would be another example of that. So there are some annuity characteristics in some of the investments, but not yet an annuity product. But we remain open-minded about that. Certainly, there's going to be a huge number of people in New Zealand who, in their retirement, will need to be able to invest in things which provide stable returns, ideally a little bit above bank deposits. And so, we've always got our eye open for that.
And I'm not sure if you're aware, Tim, but you can set up effectively a standing order to deduct or get paid a certain amount out of your savings with us regularly, which has the same effects, of course. Answer to Joe. Sam, that's
question to Joe. Apologies if I missed this, but we're in New Zealand. Your property developments, you didn't miss it, Joe. We didn't mention it, but very happy to answer it. Are they all in Auckland? The answer is yes, they are at the moment. We have 6 that we've announced and another 3 that we're working on. But the 6 we've announced are in Point, England, Onehunga, Mount Albert, and then we have a very big development going on now, Mount Wellington. We have got resource consent we've applied for, and a big one in Ellerslie, and then another one in Morningside. So, and then we have 3 other properties that we're doing due diligence on in Auckland right now. Our intention is that we will be New Zealand wide, and we do this very much on a case-by-case basis. We have a look at what's offered. Yeah, we look through Hamilton, Tauranga, Queenstown, Wellington, Christchurch, Dunedin. We're looking at all of these places all the time, and when we find the right piece of land and the right typology that the market wants for build to rent, and if the economics work out, we'll certainly consider building there. So intention to be New Zealand wide, but at the moment we're have formed a home base in Auckland, which is where the company that we effectively absorbed, that our funds now own, Simplicity Living, that's where they were based in Auckland. Although, interestingly enough, they have, in their previous lives, have built properties all over the country. All right, I don't think we have any open questions. I think that's a wrap, team. Thank you very much for joining us. And if you have any questions, please go onto our website and you can ask at simplicity.kiwi. And I'm going to do something which I'll probably be told off for doing now, but feel free to give me a call. My mobile number is 021 491 547 or at sam.stubbs@simplicity.kiwi. Always happy at your service. You've trusted us with your money, and you should be able to get hold of us and have a chat. So feel free to call or email anytime. So thanks very much for coming along, folks, and we'll see you next time.